Hello, welcome back to another weekly market recap here with Knight. Let's get to it. So this past week, we saw the S&P 500 down 4.66%, brings us down year to date 22.52%. The NASDAQ 100 was down 5.19%, which brings us down year to date 30.63%. So over the past 2 weeks, we've fallen over 5% each week in the NASDAQ and close to 5%, over 4.5% in the S&P 500. So been really brutal. We're actually hovering right around the lows that we saw this year so far in June, which we had significantly come off in August, but now again, we're testing for a second time. And really all of it is around inflation, the badness that we have, and how the Fed has reacted. So last week, really bad inflation, market sold off. This week, the Fed came out and reiterated how intense they're going to be at getting inflation down, and it had the market sell off even more. Let's get into what we specifically saw in the market. So for the first 3 days of this week, we didn't see a ton of market movement, a little bit of volatility, a little bit of sell-off right before the Fed came out, then a recovery as Jerome Powell was speaking, and then he kept speaking and the market didn't like it, sold off. Then relatively flat on Thursday, and then Friday we had another pretty big sell-off to start the day. Let's get into what specifically the Fed said that was so jarring. Now, unsurprisingly, the Fed raised interest rates another 75 basis points. So that's the third time they've done it. And it's actually what the market was expecting. So that would lead someone to say, well, if the market was expecting interest rates to go up 0.75% or 75 basis point, why did the market sell off so much? And the answer is that the market was almost guaranteed that that's what the interest rates were going to do now. The question was, what was the Fed's summary of economic projections going to be? That doesn't come out every time. And in fact, the last one was from 3 months ago. So they update that every few months as opposed to every single meeting. And what we have here was significantly different. So I'm going to show you specifically what we had from the release in June 15th. So let's look at some of these numbers specifically. For federal funds rate, the expectation 3.4% is going to be the highest in 2022, and then 3.8% in 2023, and then back to 3.4% in 2024, basically meaning that the expectation was that the federal funds rate would peak in 2023 and then start going back down. So this is what they originally projected back in June, and you can see how that even shifted from March on both ends. So March, we had gone up almost doubled what the federal funds rate was going to be. So this was a pretty large move. Again, that's because inflation was really high, really bad. And then now the market was expecting, look, we know it's not going to be pretty. It can't be the exact same SEP that we had in June. It's going to move up. But what really shocked the market was this number. So the June projection was 3.4 for the year end of 2022. That jumped all the way to 4.4. Meaning that they are not going to really reduce the rate of their federal funds increases. Again, the thought was, okay, they'll do a 75, then maybe pause for a couple times, maybe do another 25-point increase, but pause a little bit. This federal funds rate of 4.4 means that they're likely going to do another 75 and then another 50 potentially after that. So a lot more tightening. Then this was also another really big hit. So 4.6%, the market was hoping that in general, we were going to top out at 4.1. We were expecting for the end of this year, maybe 3.8, and then next year, 4.1. That little shift between each of those numbers is really why the market panicked or moved so aggressively in the final 2 days of this week. Now, again, it might not seem like this massive move, but really what that summary of economic projections said is the Fed has a lot more work than the market was initially expecting. So that's what happened on Thursday, Wednesday to Thursday that really caused that sell-off. What happened Friday? The last thing I want to show you is some of the messaging that came out on Friday. So at 5:13 a.m., you have this note that Goldman Sachs cuts 2022 target for S&P by 16%. So this has them cutting it to 3,600 points. Their previous year-end target was 4,300. So instead of having a significant 15% upside that one of the major banks was seeing for this year, they cut their expectation to even lower where the market opened today. So you put those two things together. Really bad news from the Fed. Again, more intense. The market started to sell off and then started to stabilize. Then all of a sudden you get all the major banks or analysts starting to say, oh, whoa, if the Fed's going to be more aggressive, now we think that they're going to have to raise rates longer, way more likely to be pushed into a recession over the next year. And if that's the case, we don't have the same conviction or confidence in equities that we did have. Both of those things really put a damper on equities. And in addition, we had the 10-year raise significantly over the past few days. So if we just look at that graph, it was just straight up. And specifically, if we look at the last few days, it has jumped from 3.5 all the way to 3.7. That is a massive, massive move in bonds in the 10-year treasury. And the higher that rate becomes, the more willing that people are saying, well, if I could get 3.7% return year over year for the next 10 years, risk-free, why would I not choose that over stocks that have been selling off? So with that going up a lot higher, a lot faster, on the margin, people are also saying, well, I'd rather get out of equities and get into those sort of bonds longer term, get at least some sort of return and not have to worry about all this volatility. So you have those three major catalysts this week that really led to this sell-off. Now, one of the real surprises is inflation is still coming down headline. We've seen oil come down. We're seeing a global recession, which in some ways could lead to prices just naturally coming down. So my initial thought was if we were going to see the stock market sell off so significantly, we need to see inflation almost near double digits, close to 10%. But the fact that we actually have not really gotten bad inflation data, we've just gotten really scary Fed talk over the past 2 weeks. Surprised to see this large of a reaction. That being said, the market was pricing in a much softer Fed, even from where they are right now. So in the next few months, it really is data driven. A week ago, when we had really bad CPI reading, pain was ahead. There was a chance that if we saw all of that start to come down, we could be on a very different conversation, very different path right now. But when that painful CPI reading came out, the Fed had to come out and really come down hard and say, look, we are committed to this. We are going to be absolutely brutal with these interest rate rises. We're going to have to send the US into a recession, and we don't care if we do. We need jobs, the JOLTS numbers, we need those to come down. We need a 1-to-1 balance. We need less job openings. We need more people fired, less hiring. Also, one of the really shocking things to hear from Jerome Powell is he specifically said the words, we need a hard correction in the real estate market. He basically said we need a 20% sell-off in housing prices. Now, he didn't say 20%, but that's what correction usually means. So they are not looking to stimulate the economy. They don't really care right now about that part of it. They really want to just clamp down on everything. They don't care if interest rates are high, mortgage rates are high. Right now, that's not their focus at all. They really need to get inflation under control, and they are just full eyes focused on it. They don't really care right now that the break-even rates or the inflation expectations are anchored. In fact, they said, look, while those numbers are anchored, it makes way more sense to really be aggressive in rate hikes we don't want them to become unanchored. And so they're happy to increase the current pain that's going on. And then they'll see what happens data driven and afterwards. There's a lot of really good questions about timing, the delay. Usually we've talked about this before, how there's a delayed reaction between when the Fed increases the rates and when it's felt. For the time being, Jerome Powell said you could see it anywhere up to 3 months, but not fully felt until 18 months. But that's not really their main focus. They need to see back to back to back good data and continued good data before they feel comfortable not acting or slowing down. And right now, that's just not really even on the table for them. They want to keep being aggressive. And so overall, the market is really volatile. It's going to be very, very data dependent for the next few months, as it has been for even the last few months. And that's really going to drive whether or not we are going to get through this and on the recovery path, or if there's more pain ahead. And unfortunately, the data just over the past 2 weeks has been much worse than was expected. And we've seen it accordingly in the stock market. But we really appreciate you guys. As always, we're here to support you. Your money's here to support you. If you have any questions, you're nervous about what's going on, give us a call, and I'll see you again next week.